Understanding tax brackets is fundamental to making smart tax decisions. Tax brackets determine the percentage of your income that will be taxed at each level. By knowing where you fall in these brackets, you can strategize to minimize your tax liability. Being aware of your tax bracket helps you make smarter financial moves, such as timing income or deductions to reduce taxes. End quote. Contributing to retirement accounts, such as a 401k or IRA, can provide significant tax advantages. Contributions to traditional retirement accounts are made pre-tax, which reduces your taxable income for the year. Additionally, many employers offer 401k matching contributions, which is essentially free money for your retirement. Maximizing these contributions helps you save for the future while minimizing your current tax burden. Tax-deferred accounts, such as 401ks, IRAs, and certain annuities, allow your investments to grow without being taxed until withdrawal. This gives your money more time to grow and compound, which can lead to a larger nest egg. By taking full advantage of these accounts, you reduce your taxable income in the short term and postpone taxes until retirement when you may be in a lower tax bracket. A health savings account, HSA, is a tax-advantaged account for individuals with high-deductible health plans. Contributions to an HSA are tax-deductible, the funds grow tax-free, and withdrawals for qualified medical expenses are also tax-free. HSAs allow you to save for future medical expenses while lowering your current taxable income. They are one of the most tax-efficient savings vehicles available, and contributions can continue throughout your working years. Tax credits directly reduce the amount of tax you owe, unlike deductions which reduce your taxable income. Common credits include the Earned Income Tax Credit, EITC, Child Tax Credit, and Education Tax Credits. These credits can result in significant savings, especially for families and individuals with qualifying expenses. Be sure to research and claim all eligible credits to reduce your tax liability and maximize your refund. Itemizing deductions can sometimes provide greater tax savings than the standard deduction. Common itemized deductions include mortgage interest, state and local taxes, medical expenses, and charitable donations. However, it's important to calculate whether itemizing is beneficial for you. If your total deductions exceed the standard deduction amount, itemizing can lead to a lower taxable income and reduced tax liability. A 529 plan is a tax-advantaged account designed to help save for education expenses. Contributions to a 529 plan may be tax-deductible in some states, and the funds grow tax-free as long as they are used for qualified educational expenses. This strategy helps reduce the tax burden while preparing for future educational costs. The money in a 529 plan can be used for tuition, books, and other qualified expenses for college, K-12 education, or apprenticeship programs. Tax loss harvesting is a strategy where you sell investments that have decreased in value to offset gains in other parts of your portfolio. The losses you realize can be used to reduce your taxable income, helping to lower your overall tax liability. This strategy is especially useful in years when you have significant capital gains. However, be mindful of the wash sale rule, which prevents you from claiming a loss if you buy the same or substantially identical security within 30 days. If you have children or dependents, you may qualify for tax deductions or credits that can lower your tax liability. The child tax credit, for example, provides up to $2,000 per child under 17, and you may be eligible for additional credits for dependents over 17. Make sure to claim all eligible dependents and understand the specific rules that apply to your situation to maximize your savings. Municipal bonds are debt securities issued by local governments, and the interest earned on them is often exempt from federal and sometimes state and local income taxes. Investing in municipal bonds is a smart tax strategy for individuals in higher tax brackets looking to generate tax-free income. Keep in mind that the tax advantages of municipal bonds make them a more attractive option in a higher tax environment. A flexible sending account, FSA, is another tax advantage account that allows employees to set aside pre-tax dollars for eligible healthcare or dependent care expenses. Contributions reduce your taxable income for the year, and withdrawals for qualified expenses are tax-free. FSAs can help you manage healthcare costs while reducing your overall tax burden, but be mindful of the use it or lose it rule, as funds not used by the end of the year may be forfeited. Expense A. Refinancing your mortgage can have both financial and tax benefits. The interest you pay on your mortgage may be deductible if you itemize your deductions, which can lower your taxable income. Refinancing to a lower interest rate can also save you money on your mortgage payments. However, be aware that refinancing costs may reduce the potential tax benefit in the short term, so make sure the long-term benefits outweigh the immediate costs. A Roth IRA offers a unique tax advantage. Contributions are made with after-tax dollars, but the money grows tax-free, and withdrawals in retirement are also tax-free. This can be a beneficial strategy if you expect to be in a higher tax bracket during retirement. Since contributions are not tax-deductible, Roth IRAs are ideal for individuals who anticipate being taxed at a higher rate later in life and want to lock in tax-free growth. If you're self-employed, there are numerous tax deductions available to reduce your taxable income. You can deduct business expenses such as home office costs, travel expenses, equipment, and even health insurance premiums. By keeping detailed records of your business expenses, you can significantly reduce your tax burden. Consult with a tax professional to ensure you're maximizing all possible deductions available to business owners. The Child Independent Care Credit helps offset the cost of childcare and other dependent care expenses. If you pay for childcare while working or looking for work, you may qualify for a tax credit. The credit is a percentage of your eligible expenses, and the more children or dependents you have, the higher the amount you can claim. Make sure to keep records of your childcare costs to take full advantage of this credit. Donating to qualified charities can provide significant tax benefits. Charitable donations are tax-deductible, meaning they can reduce your taxable income. This can be especially valuable in high-income years. In addition to direct monetary donations, you can also deduct the fair market value of donated goods, such as clothing or household items. Just be sure to keep receipts and documentation of your donations for tax reporting purposes. If you've made profitable investments and incurred capital gains, you can reduce your taxable income by offsetting those gains with capital losses from other investments. This strategy is known as tax loss harvesting and helps reduce your overall tax burden. While you can offset gains with losses, you can also carry forward any excess losses to future years, providing long-term tax benefits. 401k plan is one of the most popular retirement savings options, and contributions to this account are made pre-tax. Contributing to a 401k plan reduces your taxable income in the year you contribute, providing immediate tax savings. Many employers match contributions, essentially offering free money. To maximize your tax savings and retirement potential, contribute at least enough to take full advantage of employer matching. If you own a business, maximizing your business expenses for tax deductions is a smart strategy. Writing off business expenses such as office supplies, utilities, and employee wages can reduce your taxable income. Keep detailed records of all business expenses to ensure that you're capturing all eligible deductions. Properly managing business write-offs allows you to reinvest savings into your business while minimizing your tax liability. Tax laws are complex, and they change frequently. Consulting with a tax professional is a smart strategy to ensure you're making the most of your tax situation. A tax advisor can help you navigate complex deductions, credits, and tax strategies specific to your income and financial situation. Professional advice can maximize your tax savings, avoid costly mistakes, and help you plan for the future. Tax-deferred growth vehicles such as 403(b)s, traditional IRAs, and annuities Allow your investments to grow without being taxed until you withdraw them. This allows your money to compound more efficiently, helping you build wealth faster. By contributing to these accounts, you delay paying taxes on the growth, which can be beneficial in the long term, especially if you expect to be in a lower tax bracket during retirement. Investing in tax-efficient assets, such as index funds and municipal bonds, can help minimize your tax liability. Index funds generally have lower turnover rates, which means fewer taxable events, while municipal bonds often provide tax-free interest income. By incorporating tax-efficient investments into your portfolio, you can maximize your returns while reducing the impact of taxes on your investments. When it comes time to withdraw funds from your retirement or taxable accounts, the order in which you take distributions can impact your taxes. For example, withdrawals from tax-deferred accounts like traditional IRAs are taxed as ordinary income, while withdrawals from Roth IRAs are tax-free. By withdrawing from the most tax-advantageous accounts first, you can reduce your overall tax burden and preserve wealth for future use. If you're in a high-income year, consider deferring a portion of your salary or bonuses to a future year. This strategy can help lower your current year taxable income, potentially reducing your tax bracket and saving you money on taxes. Speak with your employer or tax advisor about the possibility of deferring compensation or utilizing tax-advantaged vehicles like deferred compensation plans to minimize taxes. Gifting assets to family members can be an effective way to reduce your taxable estate while providing financial assistance to loved ones. The IRS allows for annual tax-free gifts of up to a certain amount per recipient. Additionally, inheritances passed on to heirs are often tax-free, allowing you to transfer wealth without incurring tax penalties. These strategies can help reduce your estate tax liability while supporting future generations.